Most Americans think sending money to their own family is a private transaction. A birthday gift to a nephew, tuition help for a niece, a down payment toward a kid's first house. Simple, personal, nobody else's business. And for a long time that was true. The IRS physically could not monitor a transaction between two family members unless somebody got audited and a human agent specifically pulled the paperwork. That era is officially over. As of 2026, the IRS runs 129 active artificial intelligence programs, up from just 54 programs 2 years ago. Those programs pull data from every single bank, every payment app, every brokerage account, every mortgage company, and every state tax agency in the country. They do not sleep. They do not take weekends off, and their single job is to watch for transfers the IRS thinks should be gifts, should be taxed, or should at least be explained. If you have been sending money to family thinking nobody is paying attention, I have bad news for you. Somebody just started. The first thing to understand is that the IRS is not using one AI system. It is using 4 of them, and each one is built for a different type of taxpayer. The oldest and most famous is called the Discriminant Function System, or DIF for short. This one has been running in some form since the 1960s, but the modern version is completely different. It scans every single personal tax return in the United States and compares the numbers on your return to statistical patterns for people who look like you. Age, income, zip code, profession. If your deductions suddenly change, if your bank deposits do not match your reported income, if you are writing round numbers instead of exact figures, DIF flags you not to an agent, to another algorithm. The second system is called the Individual Taxpayer Model. This one is newer and way more dangerous. Instead of looking at 1 year of your return, it looks at your entire filing history. 5 years, 10 years, 20 years if you have been filing that long. And it does not just flag problems. It recommends exactly which 3 issues on your return are most likely to produce an adjustment if an agent actually opens the file. In other words, if an audit ever happens, the IRS already knows what it is looking for before the agent sees your name. The third system is called the Line Anomaly Recommender. This one is brand new. It replaced the older methods the IRS used to select corporate returns for audit, and it now scans returns from high net worth individuals filing business income, partnership income, and real estate holdings. It does not look at one line on your return. It looks at the relationships between every line and compares them to what should mathematically match up. If your depreciation does not match your stated asset pool, if your partnership distributions do not match your capital account, it flags you. The fourth system is the most aggressive. It is called the Large Partnership Compliance Model. Before 2021, the IRS flagged around single digits of large partnership returns per year for audit. After this system went live, that number jumped to 82 flagged returns in a single year. That is an increase of somewhere between 10 and 100 times the previous audit intensity. If you are in any kind of family limited partnership, family trust, or pass-through entity that holds family assets, this system is the one watching you. All 4 of these systems pull data from the same shared pool. The IRS calls it the Compliance Data Warehouse. It contains every dollar you have ever deposited, every form your employer has ever filed, every 1999 the IRS has ever received about you, every payment app transaction flagged to them, and every suspicious activity report any bank has ever filed on your name. None of this data requires a warrant. None of it requires you to be notified. The IRS does not have to tell you they have it. They just do. Let me walk you through exactly how this catches families in the real world. Imagine you have been giving your adult son $10,000 here, $15,000 there across a span of 3 years. You did it in cash sometimes, Zelle other times, and a couple of Venmo transfers for the round numbers. Everything felt informal. Everything felt private. Now 6 months later, that son turns up at a car dealership and puts a $70,000 down payment on a new pickup. The dealership reports the cash portion of the purchase on Form 8300, which is an IRS form specifically designed to catch large cash transactions. The title company sends the loan data to the credit bureaus, which the IRS also scrapes. Then your son files his tax return showing an annual income of $42,000. The IRS AI now sees a mismatch. $42,000 in reported income, $70,000 in a down payment, no inheritance on file. That is a lifestyle to income mismatch, and it gets flagged automatically. From that flag, the AI traces backward through his banking history looking for the source of the funds. And that is exactly where your Venmo transfers to him start lighting up the screen. The algorithm does not need to understand that you love your son. It only needs to see the pattern. Once it does, the case goes into a queue that an agent eventually reviews. And by the time an agent looks, the entire 3-year history of your gifts is already laid out in front of them in a tidy chronological table. Now here's where it gets specific for family gifts. The annual gift tax exclusion in 2026 is $19,000 per recipient. That means you can give any one person, your kid, your grandkid, your niece, your friend, up to $19,000 in a calendar year and owe absolutely nothing. Married couples can double this by electing gift splitting on a Form 709. That puts the number at $38,000 per recipient per year. Send your adult son $38,000. No tax, no reporting, no filing, completely clean. Do it again in January. Completely clean. But the second you go even $1 over the annual exclusion, everything changes. You now have to file a gift tax return. That is Form 709. And here is where most Americans get a nasty surprise they do not see coming. Form 709 is not just a reporting document. It is the thing that starts a 3-year clock on the IRS ability to audit that gift. As long as you file it correctly, the IRS has 3 years to come back and challenge the gift. After that, they legally cannot. That is the good news. The bad news is this. If your Form 709 has what the IRS calls inadequate disclosure, that 3-year clock never starts. Not for 3 years, not for 10 years, forever. The IRS can come back and audit that gift 20 years from now, 40 years from now, after you are dead, after the person you gave it to is dead, and demand full payment with penalties and interest. And what counts as inadequate disclosure is shockingly broad. If you wrote gift to nephew instead of gift of $18,500 in cash to John Doe's social security number ending in 4877, that is inadequate. If you did not include the fair market value of the asset on the date of the gift, that is inadequate. If you did not describe the asset in enough detail for a valuation expert to understand it, that is inadequate. Most people who fill out their own 709s fill them out inadequately, and the IRS is not obligated to tell you. In fact, the IRS has no incentive to tell you because as long as your disclosure is inadequate, they can circle back whenever they want decades later when memories have faded and records have been lost and hit you with the maximum tax plus penalties plus compounded interest. This is not a theoretical risk. This is the single most common gift tax trap in the entire United States tax code. And it applies even to families making tiny gifts because a tiny gift filed wrong has no statute of limitations at all. The lifetime estate and gift exemption for 2026 is $15 million per person. That number comes from the One Big Beautiful Bill Act that passed at the end of 2025. What that means is as long as your total lifetime gifts stay under $15 million, you will not actually owe any federal gift tax when you file the 709. But you still have to file it and you still have to disclose it correctly or the IRS keeps you on the hook forever. Most people assume that if the tax comes out to zero, the disclosure does not matter. That assumption has cost families millions of dollars in back taxes and penalties over the past decade. Now let me talk about the part that is really new in 2026, which is how the IRS sees your payment apps. This is the first year the 199K threshold has been fully settled after years of back and forth. The current rule is this: payment apps have to send you and the IRS a 1999K. If you receive more than $20,000 in a calendar year and more than 200 separate transactions on that app marked as payments for goods or services, both conditions have to be met. One or the other is not enough. That is the One Big Beautiful Bill Act rule, and it is expected to stay. Venmo, PayPal, and Cash App all follow this rule. Personal transfers between friends and family marked as not for goods or services do not get reported. Transfers between spouses do not get reported. Zelle does not report at all because Zelle does not technically hold the money. It just moves it between banks. So people assume Zelle is invisible to the IRS. That assumption is completely wrong because your bank sees every Zelle transaction and your bank has to report suspicious patterns to the Treasury Department Financial Crimes Enforcement Network. That network, called FinCEN for short, shares everything it sees with the IRS. So, if you use your adult daughter $15,000 every month like clockwork and she uses it to pay her rent, it is possible no one ever notices. If you Zelle her $30,000 in one day, then $10,000 the next week, then $5,000 3 days later, your bank will absolutely file a suspicious activity report and you will never know it happened. That is the specific rule buried in Title 31 of the United States Code Section 5318. Banks are legally prohibited from telling you they have filed a report on your transactions. You will find out only if and when the IRS actually shows up with questions. There is one more bank reporting threshold everybody should know about. It is called a currency transaction report, and it is triggered automatically anytime you deposit or withdraw more than $10,000 in cash. The bank has no discretion here. It does not matter if it is your own money. It does not matter if you are withdrawing for a legitimate purchase. The bank files a FinCEN Form 104 every single time. The IRS has direct access to this database through something called the Bank Secrecy Act search tool. And they can query it without getting a warrant, without notifying you, and without telling their own leadership. Now I have to pause here and cover something most Americans have never heard about. But it is the single most dangerous family money move I see happen over and over. It is the joint bank account. Most parents, when their kids reach adulthood, think it is smart to just add the child to their checking account so the child can help pay bills if the parent gets sick or elderly. It feels like common sense. It feels like love. It is unfortunately one of the most destructive choices you can make in American tax law. The second you add your adult child to an account you own, the IRS has grounds to argue that part of that money was gifted to them on the day their name was added. They do not always pursue it, but if you ever need to prove it was not a gift during an audit, during probate, during a dispute with another relative, or during a divorce, the burden of proof is on you. And the paper trail is permanent. Every deposit that flows through that account gets attributed partially to the added owner. Every withdrawal made by the joint owner gets scrutinized as evidence of access. If your child takes $10,000 out of the joint account to pay for their own car repair, the IRS can view that as either a gift from you or a pre-inheritance distribution. Either way, it is tax drama. The second trap buried in American family money transfers is what happens with inherited property versus gifted property. And it is a trap most families walk directly into without realizing what they have done. Here is the rule. If your mother gives you her house during her lifetime, you take over her original cost basis. If she bought it in 1985 for $60,000 for your basis is $60,000. When you sell it for $600,000 later, you owe capital gains tax on the difference. That is $540,000 of taxable gain. At the 20% long-term capital gains rate plus state tax plus the 3.8% net investment income tax, you are looking at a tax bill over $130,000. But if instead she leaves the same house to you and her will when she dies, you get what is called a stepped-up basis. Your basis resets to the fair market value on the day of her death, which in our example is $600,000. You sell it the next day for $600,000, your capital gain is zero. Your tax is zero. Families give away houses to kids during life thinking they are being generous and saving on estate tax. And they end up gifting their kids a six-figure capital gains bomb that the IRS patiently waits to collect when the kid eventually sells. Every single family planning to transfer real estate needs to understand this distinction. Lifetime gift equals carried basis equals tax. Inheritance equals stepped-up basis equals no tax. If you can afford to hold the asset until death, you almost always should. And in April of 2025, the threshold got even scarier in parts of the country. FinCEN issued something called a geographic targeting order that lowered the currency transaction reporting threshold for money services businesses in the southwest border zip codes from $10,000 to $200. That order ran through September of 2025. Similar orders have been issued and extended in other regions since. If you live near a targeted zone and you walk into a Western Union with $300 in cash, you are now in the FinCEN's database permanently. So, what does all of this mean for a regular American family just trying to help each other financially? The first and most important thing to understand is that ignoring the rules is no longer an option. The IRS had about 102,000 employees at the start of 2025. By December of 2025, they had 74,000. That is a 27% drop in human workforce in less than a year. And in response, the agency did the opposite of what you would expect. They did not scale back enforcement. They scaled up the AI. They now audit with surgical precision. Fewer audits, but the ones they do open are chosen by an algorithm that already knows what it wants to find. The audit rate on gift tax returns used to be about 1%. It is still about 1% today. That sounds low until you understand that the audit rate on estates worth over $10 million is 22%. 1 in 5. And the audit rate on anything the AI flags as inadequately disclosed is far higher than the base rate because those returns have no statute of limitations. The IRS can sit on them for decades and audit them whenever enforcement priority shift budget allows, or somebody new with access to the database starts looking. Now here is the good news. There are 5 specific strategies families use every single day completely legally that bypass all of this surveillance. The first one is gift splitting. If you are married, both you and your spouse can each gift the full annual exclusion to the same person in the same year. That means a married couple can give up to $38,000 per recipient per year with zero tax and no 709 required. A couple with 4 adult children can legally transfer $152,000 per year every single year to their family with no reporting to the IRS at all. The second strategy is called the direct payment exception. This one is not widely known, and it is one of the most powerful moves in the tax code. If you pay tuition directly to an educational institution or medical expenses directly to a hospital or doctor on behalf of another person, the IRS does not count it as a gift at all. Not partial credit, full exemption. You can pay $100,000 for your grandchild's college tuition this year, and it does not use up a single dollar of your annual exclusion or lifetime exemption. It is completely invisible to gift tax rules. The only requirement is that the payment goes directly to the institution, not to the family member. If the money touches your grandchild's account first and then goes to the school, it counts as a gift. If you write the check directly to Harvard, it does not. The third strategy is the 5-year election for 529 plans. A 529 plan is a college savings account with huge tax advantages. And there is a special rule that lets you treat a single lump sum contribution as if you spread it over 5 years. That means in 2026, you can contribute $95,000 to one person's 529 plan in a single year. File a 709 declaring the 5-year election, and it is treated as if you gave $19,000 per year for 5 years, completely legal, completely within the annual exclusion, and the money grows tax-free, comes out tax-free when used for qualified education expenses, and never shows up as a gift in any future year. The fourth strategy involves something called a crummy trust. The name comes from a court case decided in 1968, not a description of the quality. A crummy trust lets you place money in an irrevocable trust for a beneficiary. And as long as that beneficiary has a short window each year to withdraw the gift, the contribution qualifies as a present interest and uses your annual exclusion. This is how wealthy families move tens of millions of dollars to their kids and grandkids without ever filing a taxable gift. You fund the trust with $19,000 per beneficiary per year. The beneficiary gets a letter saying they can withdraw it within 30 days. They choose not to. The money stays in trust. Repeat every year for 30 years. You have now legally moved $570,000 per beneficiary with zero gift tax. Multiply by multiple beneficiaries across multiple generations, and you can see how families quietly move tens of millions of dollars this way. The fifth strategy is spousal transfers. Federal tax law treats husband and wife as one economic unit for gift tax purposes. You can give your spouse unlimited amounts of money, assets, property, stock, whatever, and it is not a gift. It is not reportable. It does not use any exemption. Spouses are effectively transparent to the gift tax system. The reason this matters is that a lot of families use this as a rebalancing tool. If one spouse has an asset they want their kids to inherit, they can transfer it to the other spouse first and then have that spouse do the gifting. This opens up a whole new annual exclusion and a whole new lifetime exemption, effectively doubling the family's tax-free transfer capacity every single year. Now, here is the most important part of this entire video. The IRS AI does not care about intent. It does not care that you love your family. It does not care that the money was meant as a wedding gift or a graduation present or help with a medical bill. It only cares whether the patterns match what its model has been trained to expect. If a parent regularly sends $19,000 to each adult child, the AI considers that normal. If a parent suddenly sends $18,999, the AI flags the number as suspicious because that pattern looks like someone structuring a transaction to stay $1 under a reporting threshold, which is itself a federal crime called structuring under Title 31 of the United States Code. The IRS does not have to prove you did it on purpose. They just have to see the pattern. So, here's what you do if you want to help your family without ending up in the database. First, stop thinking in terms of what you are allowed to give and start thinking in terms of what you can document cleanly. Every transfer needs a clear memo. Every transaction needs a reason. Every gift over the annual exclusion needs a proper 709 filed with full disclosure. Second, use the tools the tax code actually offers you. The direct payment exception, the 529 plan, the crummy trust, the gift split election. These are not loopholes. These are the rules. Wealthy families have been using them for decades, while middle-class families have been paying unnecessary tax because they did not know. Third, understand that the IRS AI will continue getting more aggressive, not less. The agency is shrinking in people but growing in processing power. They will not audit more returns next year. They will audit fewer, but the ones they do pick will be chosen by systems that already know exactly where the money is, exactly who sent it, and exactly how to prove it was taxable. You do not want to be in that data set when the algorithm runs. The final piece is this. Every family transfer you make in 2026 lives in a permanent digital record. Your bank sees it, the payment app sees it, Finansen has it. The IRS can query it without asking you. For the first time in American history, the tax agency has the ability to watch everyone's finances in real time, not selectively, not just during audits, but continuously. And they are using that ability right now. Let me give you one more real scenario that is playing out in tax courts across America right now. A grandmother in Pennsylvania gave her grandson $90,000 over the course of 4 years to help him through medical school. She did not know about the annual exclusion. She did not file any 709 forms. She wrote the checks directly to him because she loved him and trusted him and wanted him to become a doctor. 3 years after the last check, her accountant filed her annual tax return and the IRS AI flagged a mismatch. Not in her return, in her bank records. The algorithm noticed that her checking account was producing large outflows that did not match her income pattern, and her grandson's account was receiving deposits that did not match his earnings. It took 2 years for the case to make its way through the IRS system, by which time the grandmother had passed away. Her son, the executive of her estate, was handed a bill for $72,000 in back gift tax penalties and compounded interest. The original gifts properly filed on 709 forms with adequate disclosure would have owed exactly $0 in tax because the entire amount fit under her lifetime exemption. She just never filed the paperwork. That is how families lose fortunes, not through aggressive tax planning, through ignorance of what the algorithm sees. The families who are going to navigate this well are the ones who learn the rules, file their 709s correctly, use the exceptions that exist, and treat every transaction like it is being watched. Because from this year forward, every single transaction is you cannot hide from the algorithm, but you can use the rules to make sure it has nothing interesting to find.